Today's number is 24,000. Why? Well, it all has to do with a few whales and what they've just done to Bitcoin markets. Does this lead into the bear trap narrative and then a euphoric run? In today's video, we'll break down what this means for cycle analysis as gold starts to rise up with silver once again, and we start to see Wall Street make big moves. Could it be that small caps are really about to fire up similar to previous periods? Well, in today's video, we'll break it all down together, so join us as we cover stocks, commodities, and cryptos. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we have some very bad looking charts, and of course, we have a potential silver lining, at least for now. Let's kick things off though with the bad charts, and then we'll go through what it really means for us as investors and traders. And first up, of course, courtesy of Bloomberg here, you can see US stock valuations are hitting all-time highs. Now, this is when you take all different types of ratios into consideration, and we're starting to now to reach periods that have not necessarily done well in post-activity. Often recessions, classic ones, of course, being the 1920s and then the dot-com boom. And of course, now similar to 2021, where we're reaching for the stars. So does this mean panic yet? Well, the answer is generally no when you look at markets like this, because as you guys know, markets each time end up creating a bigger bubble and they end up doing it in a different way. So here are some stats that really will surprise you. And the first one is there are now more exchange traded funds than stocks in the market. Yes, you actually heard that correctly. More different ways to trade the stocks than the stocks themselves. And actually, I saw this chart today and I had to laugh because that is something that I expected to potentially occur, but it just shows that the word ETF has now become synonymous with safety and all of these other things. Of course, I always say, whenever you're looking at an exchange traded fund, check the fact sheet, guys, because yes, it means it's traded on the exchange, but it doesn't necessarily mean it's the right strategy for you. Now, while that's all happening, we also have a record percentage of investors saying US equities are overvalued. Now, I think this is interesting because I actually did a little search on Google, and what I found is that the word bubble and stock market is now up there with around January of 2021. Not quite at those peaks, but certainly getting up there. Now, why this is important is because remember, when everyone thinks it's a bubble, usually there's further to go. It's when everyone says, oh, I'll just get in and, I know it's a ripoff, but I'll get out before everybody else. No worries. That's when you've got to be most concerned. So I think we're in the stage right now where everyone's saying the AI bubble is happening, and that's clearly becoming the search term of the current market condition. So why is this all important? Well, it all comes down to when you're looking at markets, you have to consider many different charts and not just one data stat. We know that by general metrics, maybe the market's completely overpriced. But when you take a look at price to earnings ratio and you look at the equal weighted market, not just the cap weight, which obviously is mostly tech, you get a little bit of a different picture. And this is very different to what was happening back in 2020 and 21, which is where we saw equal weighted markets actually catch up with the cap weight. And they were a little bit more, I guess you would say, strong when you were talking about the breadth across the board. Now, does this mean that things like RSP and other codes could start to do better in the future? Well, that's something that we've been discussing, a broadening of this market rally so far to really suck everybody in to every particular stock in the market, not just to have 10 to 30 stocks that are really making up over 80% of all of the moves so far. And if you've been watching this channel for a little while, you'll notice that we started to see this change about 2 weeks ago in flow, more so than we saw in the narrative. And now all of a sudden, people are starting to recognize that. Remember, the price action on the charts and the ratios that we use in these videos makes a huge difference to your understanding of markets. And I hope you guys enjoy it. Make sure to give it a like, and also make sure to subscribe if you're new to the channel if you like that type of thing. Now, here's a stat that I follow quite closely, and it's certainly something I'm looking for to show euphoria, and that is average IPOs and the amount of IPOs on list. So you can see here, this year is better than last year when it comes to IPOs. 2025 is clearly an improvement in market conditions, but it's not quite up there with those heights of 2021 when everybody wanted to list a new business. Now, this is thanks to Callie Bost over on X, so I definitely suggest you go and check out her work. But you can see here that we have seen the best reception. So that is that when you get an IPO coming to market, the results are absolutely ballistic. And you might think, well, 2020, 2021 surely was higher. Well, it turns out no. The average first day result for public stocks this year has been 34.5%. And guess when the last time we saw something like that was? Yeah, it was the 2000s. So it makes you start to question, well, wait a second, are we in a euphoric run? Well, we're certainly seeing the euphoric style responses in the market, but not quite enough new IPOs coming to markets just yet. And you'll see the difference here with what happened in 2020 and what happened in the current market conditions. And there are reasons for this as well. If you go back to the 2000s, you'll see a similar thing. Lots and lots of companies going public as it was a great way to make money. But you've got to remember in recent years, it's all been about venture capital or angel investment and keeping things private until they become basically so big that they could instantly enter the S&P 500. So it's a little bit of a different market from that aspect, but I do think that we're starting to see that euphoria come through, and I would expect more IPOs to launch into 2026 as well based on these results. Something certainly to watch. Another big announcement of the last 24 hours, things just keep getting wilder in 2025, which is that Trump has supposedly sent a letter here to Governor Cook of the Fed and saying that she should resign, it looks like. And of course, this is creating some pressure on the dollar as we're starting to see all of this come to a head into, of course, next year. So what do we expect? Well, I don't know. I don't know if this is even enforceable. I'm not particularly, au fait with that type of stuff, guys. But what I do think is that clearly we're going to see more and more information about the Fed as we get closer to Jerome Powell's end. And we've already started to see, of course, Jerome Powell saying, well, we're going to go with dealing with the unemployment problem and not the inflation problem. We've got some charts coming on that later on today's video to really show you how that could end up causing a big issue in the markets, although we haven't seen anything yet. And I think that's always the key point. When you're looking at this data, some of it's relevant to the future, some of it's relevant to right now. But ultimately, the price action and the flow, that is what Wall Street's really doing, not what they're saying is the most important factor that we always look at. That's why we bring it all together on this particular channel. Now, let's have a look at the VIX. So the VIX has actually been crushed. According to Charlie Bilillo, you can see here 69% decline in the VIX over the last 20, well, this is VIX recently, is now the largest, basically, we've seen in history, I believe. And you can see this is over a 20-week period, and this means that if you take a look at what tends to happen into the future, yeah, it's pretty bullish. Now, I don't know if I'd go this far ahead, as in 1 year, 2 year, 3 year, 4 year, 5 year, etc. But it does certainly show that when you see VIX crushes like this, sometimes it can bring the bull back out into the markets. Another thing that's bringing the bull is something we alerted you guys to, which was the classic breadth thrust, my favorite, the Zweig breadth thrust. We got the Whaley, the Zweig, and the 7070. They're my three favorites when it comes to buying into the market. And we saw this back in, of course, the April period. Since then, has this Zweig breadth thrust been doing about as good as the other ones have? Well, the simple answer is yes. We have seen incredible results, and that's a little bit higher than the average, but still, where do we find ourselves at right now? Not quite near the end of the traditional kind of run, but certainly getting up there. And around this kind of 100 to 126 days is on average where you start to see what we would call a pit. And why is that? Well, often the beginning of the rally is driven by innovation, tech, that kind of thing. Then you get rotation. And then, of course, if the market is going to continue to go bullish, and we've got some charts on this structure coming up soon, then it will continue on, but this time with more stocks than the initial startup did. So why is this important? Well, of course, it all has to do with the next couple of months. Now, we know that August, September, October are the most volatile months of the year in markets. And we also know that markets tend to do okay into public holidays. Now, if you weren't aware, we've got Labor Day, of course, coming up in the US next week. And that means that we need to look at the Labor Day statistics. Traditionally, it's been bullish into Labor Day and bearish potentially afterwards, at least if you look at just the statistics alone. And you can see here, courtesy of Jeffrey A. Hirsch, Almanac Trader, you can see over on his X, he's posted this detailed Wednesday, Thursday, Friday analysis for this week, which shows that Wednesday traditionally is the more bullish day, Thursday's bit of mixture, and Friday is slightly negative. So if you were taking on average, you can see here how the days may play out. and the percentages around those. Now, you don't want to trade off just that, of course. You want to use price action and you want to use your flow analysis, but it is still, I think, a very interesting stat. So let's go and have a look at the broader economy. Is it healthy right now? Do we have anything to worry about? First up, Goldman Sachs, of course, from Mike Siccardi here. You can see they've said that they believe the GDP is going to show growth. So that means that at this stage, AI is really kind of compensating for everything else that's weakening out there. And this is basically leading into, I guess, no official call for a recession because GDP is, of course, not declined on two particular reads just yet. They also expect, Goldman Sachs here, that inflation could be rising up to around 3% by the end of the year. And if you saw a recent report, you'll notice that we were talking about the idea that by October, we should be starting to see the pass-through effects of these tariffs onto the American consumer. And that, of course, could start to falter the market as well, forcing the Fed to maybe do even more cuts. Remember, the thing about a kind of weakening economy is that it needs support. So far, it's got tax. So far, it's got buybacks. It's got all of these different artificial things holding this market up. So now the market's going to be looking to the Fed to just do quite a few cuts. And if they don't, then it might have a bit of a fit. And this is the thing that most people are concerned about, that if the Fed starts to aggressively cut, could it mean that we're actually already in a recession? So traditionally, when you've had aggressive cut rates by the Fed, it means something seriously wrong. Remember, the pace of the cut is important. If they cut 25 basis points, then maybe 2 months later, cut 25 basis points, blah, 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 keep going through like that, it's usually considered healthy. If they do massive cuts and then continue to do maybe 2 massive cuts after each other, that is a big problem. And it's all got to do with the cut rate that will be very, very important. You can see here how the market performs into a cut and after a cut, at least initially, is often when you get the actual fact, that is the cut itself, the market sometimes drop and then a good one will actually rally up. And you can see that the stats are towards the upside, especially when you're at all-time highs. So when the Fed does that at all-time highs, it's a 50-50 coin flip for the next month. So again, it depends whether you want to be looking for that potential dip or volatility market. And then after that, actually turns pretty positive. You can also see here that when we have bullish days like we did thanks to Jerome Powell's speech and more likely just an excuse from Wall Street, that it actually does also lead into relatively good reads into the future. So this is the chart you've got to watch, and it's really structure related. We did this back last year when we got the first Fed cuts, and of course we looked at the first 1 to 3 months of structure. When we ended up getting bullish structure across the board, that basically told us that, at least according to the market, we were not going into a recession and we were on the average kind of run, which turned out to be pretty good. Now, was there a problem in between? Of course there was. We ended up getting the tariff and Liberation Day. But in general, guys, it's pretty much been as you would expect by the run-of-the-mill average no recessionary market. This time around, though, the first 1 to 3 months will be worth watching. And of course, we'll be covering it very closely together. So stay tuned for that. Some other things around the market that are worthwhile noting. Bullish oil bets are falling to 17-year lows. We first reported this on the weekend. And since then, we actually started to see oil pick up a little bit, started to break out of some resistance, and we'll take a look at that later on today's video, but that is certainly a very interesting one. And in terms of seasonality for this time of year, it's usually positive into around the September period, the start. Then, of course, because of Labor Day, post, etc., sometimes you have a little bit of weakness in the September period. That's the most volatile kind of period of the year. And then usually by October, November, according to Wayne's study here from Wayne Whaley, you can see here it's overall quite bullish. So again, we kind of expect this type of market, which is up, down, and all around, a rotation, a movement into other sectors. Remember, if you don't have tech leading, tech is like 42% plus of the S&P 500. So if it's getting rotated out of, it's very difficult for the S&P to actually do anything. And you'll see the Nasdaq has actually been weaker than the others. So let's go from the stock market, which could be still in a volatile period of adjustment, which we'll look at on the charts, to the crypto market, which is certainly falling. So according to the data we got over the weekend, you can see here that 24,000 Bitcoin was sold, and this was about $2.7 billion worth on the weekend. Now, you could argue this is showing you that liquidity is not that great in Bitcoin, but I would also say, well, it was happening in the weekend, but it led to a $4,000 crash in just minutes. And this actually fell through a level that looked better post Jerome's speech, which was 112,000. Now, because we're through there, how much lower could we go? Later on, we'll have a look at this, but this actually could play into the narrative that we've been going on about recently, which is that there is usually a bear trap before an extreme FOMO euphoria event, at least if Bitcoin is to play the general cycle. And the way it usually works is that Bitcoin leads for ages and ages and ages, then Bitcoin gets crushed. At that point, Ethereum and other alts actually hold better, which is kind of like the mid-alt season. And then Bitcoin comes back with a vengeance. And as it's coming back with a vengeance, you get a very, very short period. It's actually not very long. It's only around 30 to 40 days maximum. And the alt season starts to go and it ramps through. Now, could it be exactly the way that it's happened in previous halving cycles? Well, that's the million-dollar question. And of course, that's what people are looking at. But so far, it's been pretty much exactly what you would expect. Pullbacks nearer to the end. Now the question is, can Bitcoin do the recovery? And if it does, do other larger alts actually hold their own very well versus Bitcoin? Ethereum, XRP, Solana, this type of stuff. If that does take place, then it's kind of following a very similar path. And as you guys know, if that happens, then yeah, maybe the alt season really will occur. And that's when things get really, really crazy. Couple of quick reminders just to remember here that the S&P 500 generally doesn't peak in these particular months. It generally does it in December or January. So again, that's where you usually see the biggest problems in these markets. And another reminder as well is that the catalyst this week is probably going to be Nvidia. Now, do I expect it to have good earnings? Yes. Has it generally beaten expectations? Yes. If you look at the last, 30 results or whatever, it's probably been generally almost all bullish except for one. That doesn't mean the price action has to be though. So this will be volatile. Expect hundreds of billions of dollars of movement on that stock. And of course, pay attention to how everything's playing out. So let's now have a look at the S&P. It's been steadily increasing here with the advanced decline line going up, which of course is not bad for breadth. So that basically is a good sign. You can also see that we're still in an upward trend at this stage. And really, until you lose 6,200, you're not even going to be giving up the daily trend. So the daily trend is still up, but there are some signs in the Nasdaq of significant rotation. If we have a look at the futures market, here are the highs and the lows. And you can clearly see we've gone back and tested these highs at this stage. And the big level for the next 24 hours is going to be 64.50. Which is just above actually where we ended up closing for the session. So a lot of puts at 64.50. Yeah, I mean, we're going into negative gamma underneath that, but this may be enough to hold the markets up. And it's one of those important levels. If we keep seeing the S&P fall, maybe due to concerns over Trump and the Fed or whoever, whatever it's going to be in the news, it's usually an excuse, then this will be something we're watching because, of course, we've got some walls here. And if we do give up 64.50 and close underneath it, then, of course, markets could very easily be back in those 63s relatively quickly. Let's have a look at the other stocks. Anything there? Not really. Tesla going towards 350. We know that's the call wall, so it makes sense to be a resistance. And Nvidia still struggling around the 180, 185, which we know is, again, the call wall. So, of course, these are expected levels and pretty much exactly where we would expect the markets to start to find some issues again, which we've been talking about for ages. So let's now go over to the lead indicators. First up, RSP. So this is the equal weighted market. And you can see here, it's been making a series of higher highs and higher lows, and it just made an all-time high. Now, I don't class an all-time high as a negative sign in markets. It usually is positive. But sometimes around all-time highs, you do get kind of chop as the market stabilizes and gets ready to go on its next big move. So RSP, certainly one worthwhile watching on your charts. Another one is our top 10 indicator here, which is, of course, the stocks that took us up. And that weakened off around this period here, which was the August the 13th. We started to see that. And you can see that we haven't really had very good performance of these stocks since. And that's telling you again that that rotation seems to be going in underneath the hood. China stocks doing very well, something we've been bullish on. And of course, catch-up stocks, certain metals, certain commodities, And of course, even healthcare improved recently, and that was one of the most hated sectors, and energy as well. RSPT, equal weighted market, certainly worthwhile watching. 40-20 still on that chart. And you can see here when you're looking at value's been on the rise, new all-time high. And I've just quickly put a fib in here, and you can see that in general, there's plenty of levels where buyers could come back in. 180, 178, these kind of levels. So value did break out, and we started to see some rotation in that, although they have pulled back in the last 24 hours. What about the US dollar? Well, the US dollar was pressuring the downside. Now, all of a sudden, with this information coming out, maybe from Trump and the Fed, we're seeing it kind of spike back up here and getting back to the 98.50 zone. For now, I would say the dollar is kind of trapped because it became the most crowded short in the market by far. And when that happens, as you guys know, it often stagnates, so it kind of stays in a range. The gold trade, however, is improving. So this actually got through that 33.75 zone, and that's the first sign of some recovery. Now the question is, are we about to see a ballistic move on gold? Because if it gets through 34.50, at least from the technical side, you're getting past all of these lower high levels. You're starting to say, okay, the market has made its decision, and potentially that decision is in the direction of the weekly, monthly, daily trend, which would be, of course, pretty sweet. Silver's also coming with that, and it's already starting to improve. And you guys know we're looking at around 42, 43 for the initial targets here for silver, and we have been doing so since the 20s. So realistically, another nice move here on silver, and it's kind of doing what it should do, which is beating gold for now because it's been so far behind gold's price in general. Now, probably one of the surprises to some people was oil picking up over the last 24 hours. It did break above 64.30 a barrel, which is the first good sign for this on the charts. It has kind of given some base scenario kind of points here. And if you actually look at energy stocks, they have also improved. Now, you guys would know I'm not a huge fan of energy stocks because they're super geopolitical and all sorts of things. But they do have a case if we go into stagflation, because energy tends to do quite well in stagflation. So that's something we'll be looking at, and this is a key level to watch around that 89.20 for the energy sector. Nvidia, on the other hand, is trapped between 185 and 170 into earnings. So that'll be a post-earnings analysis that we'll do here on the channel. And of course, Tesla going back up to 350. If that's what you were looking for, well done to you, because that wasn't too bad. That was actually a very quick movement for 9%. So it just shows you, again, good technicals. They hold a lot of the time. They don't always, but they hold a lot of the time, and that leads into further movements. On the macro side, China just keeps pumping liquidity in, and that's, of course, coming through here in the Chinese composite, breaking to a new multi-year high, guys. That's pretty strong, and we've been following China, of course, for basically a year now on the bullish end, so it's been pretty good. US 2K, what's going on here? Well, it broke up, which I think is a good signal towards trying to get to here. We also saw at the start of today's video, I brought up IWM SPY. So that is that we've got the combo here, which is starting to break through. Not quite the 365, but this is the first significant sign here of potential rotation into small caps. And we still have the downward trend line. There's still a lot of things it needs to do to repair structure, but this is the first good sign for a long time. What probably since over here in July. So it's been a long time since we've seen anything look any good for the Russell. So yeah, certainly an improvement here on Russell trades, and some people are pretty excited about that. Now let's move over to the Nasdaq, and you can see here that the Nasdaq has been rising up, but it's actually declined, I believe, and you can correct me if I'm wrong. I can't remember if it's 8 of the last 9 days. Let's just quickly count. 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, so pretty much, we're looking at a market that isn't that great, actually. It's not as good as you would think, considering how bullish it's been. But yeah, every day just seems to have a little pitter-patter of selling. Definitely no change of trend at this stage, but I see a lot of people giving this the head and shoulders treatment. It could be something to watch, 22,800 neckline. And again, well in line to exactly what we've been expecting, which is rotation out from the hype and into some other things. Speaking of rotation, Ethereum's doing better than Bitcoin now. It's come back down, but still holding above the low over here. So I guess that's a good sign for it. And the real story is probably Bitcoin. So you can see here, I've actually got analysis drawn up here. So let's have a look at this chart. Most traded zone around 104 to 105K, depending on the data source, and liquidity swipe potential at around 98. Now, I always say, well, is this in line with what's happened previous cycles? So generally speaking, Bitcoin has dropped between 20 and 30% during a bear trap, and 20% actually is around 98. So I think this is one of those wait and see. On the weekend video, I talked about an improvement in structure through this downward trend line, and I think that still was the case. But of course, the big whale came in. Sometimes that's going to happen. The low was taken, and now the question is, how low do we go? So I'd love to know your percentage here in the comments section. Let me know, how low do we go on Bitcoin, guys, before we see a rally? Maybe some of you believe there is no rally left, but I tend to believe that usually crypto markets end with some pretty big volume, huge amounts of speculation, and I'm not sure if we saw a broadening quite like that just yet. In terms of week ahead information, it's not so much the economic data that you need to be looking at. It's more going to be in line with, of course, what are we seeing more so with NVIDIA on Wednesday. So stay tuned to the channel as we cover that one. And of course, next week is jobs numbers, which is going to be wild. So this is September the 4th. It's actually September the 5th that we're going to see the jobs numbers. That's going to be the wild day, that one there, because we know that the Fed is mandated to this particular read now. So this is now the most important data read of the month, and inflation has gone to the second one. All right, guys. Well, if you enjoyed today's video, please remember to subscribe. In general summary here, I guess it's still exactly kind of what you would expect in markets. In general, they are still bullish based on thrusts and underneath kind of health. The macro data doesn't look so good, but again, macro takes ages to play out. And I think the key here is to be aware of all the scenarios. And of course, we will continue to update you on those as we go through. If you enjoy our stuff, make sure to check out our courses as well, specifically the advanced options that we just released, the day trading masterclass, the advanced class, some great stuff there. And of course, you can follow us over on the socials. Thanks so much, guys. We'll catch you in the next one. Bye for now.